So thank you everyone for coming to the session on international finance. So we are very excited to have 3 papers. And so Paul is going to kick it off and you have 20 minutes.
Thank you. And thank you again for putting the paper on the program. This is great. So this is a new paper. It's my first intentional paper. So all feedback, comments are more than welcome. The title is Dollar Debt and the Inefficient Global Financial Cycle. And the main thing I want to talk about is the inefficient in effect. But the motivation really starts from the second line of the title, which is the global financial cycle. If you're in this room, you probably know what I have in mind. So just that everyone is on the same page. Collection of empirical facts that mostly documented by the coauthored that show that there's a global movement in asset prices, credit flows, and monetary policy over the world. And one of the striking facts about this global financial cycle is that it seems to be mostly driven by US monetary policy shocks. So when the Fed raises interest rates, there's a retrenchment of capital flows, and at the same time, a tightening of domestic policy conditions in emerging markets. And one of the reasons that has been proposed, one of the main reasons been put forward for this endogenous response of domestic central banks in emerging markets stands for the presence of dollar debt issued by this corporation in this country. So if your corporations in a country like Mexico issue it in dollar, when the Fed raises its interest rates, that causes a depreciation of your currency, makes your dollar debt more expensive to reimburse. Couple that with very standard type of financial friction, you get balance sheet effects. That's an effect that people have in mind usually, and so that's giving you negative effects on output and employment, investment, and so on. And so of course, if you're a central banker in one of these countries, there's a very easy thing you can do to fight this balance sheet effects is to fight the cause of the balance sheet effects, and that's the depreciation. One easy way to do this is to increase domestic policy rates. And so that's how you get a synchronized policy response by a lot of emerging markets at the same time, because a lot of these emerging markets actually issue debt in dollar. They all have the same problem, and so they all have to answer to Fed tightening to fight this balance sheet. Okay, and this kind of debate about the synchronized policy response, especially in Latin America, has been revived recently because of the recent increases in domestic policy rates across different countries that you have here in blue in anticipation of the Fed tightening that was about to come. And on the right, you have here very suggestive evidence that this is at least partially driven suggestively by dollar debt. So this is the share of non-national corporated that is issued in dollars in some countries, and that's the cumulative increase in domestic rates in 2021 for these countries, and you have this positive correlation. Okay. So what is the goal of this paper is to try to answer the welfare perspective of this problem here by taking the perspective of a central banker in a single emerging market economy that has its corporations issue debt in dollar. So what is the optimal monetary policy response in those cases? And then under which condition exactly do you get spillovers between these emerging market economies because of these synchronized policy responses? And since in the case where you have spillovers, that's not always the case, I'll try to make that clear. When you do have this spillover, what is the optimal ex-ante policy you can put in place in order to fight this? Because again, the first order effect that causes this, at least in this model, and this is view, is that this is caused by the presence of dollar debt on the balance sheet of these corporations, and so macroprudential policy is going to play a role here. Okay, so let me just give you a quick idea of what's inside the model. Let's start with just a simple small economy, so just one country in isolation. Let's think about Mexico, for example. You have two sides. The first side is very standard. You have households, they supply labor, but wages are rigid, so you get aggregate demand effects. That's very standard. And at the same time, you have these entrepreneurs here are going to borrow in dollars and in pesos in order to invest. They also produce non-tradable goods, but they're subject to a financial friction that's going to create these balance sheet effects I was mentioning, where depreciation is going to hurt them because the net worth is going to be reduced by the amount they have to reimburse since they issue at least some of their debt in dollars. Okay. So the central bank is going to set the domestic interest rate here and not going to have access to other instruments. And that's what, of course, is going to create spillovers, exactly because we know that from the paper by Katharina, but also by the work by Oleg and Dima here, that if you give central bankers as many instruments as their targets, then basically you go back to the global first best, and so there's no room for spillovers. Okay. So that's the timeline of the model. These entrepreneurs are going to issue some debt in dollars. It's going to be V1 star here. Then in tier 2, they're going to be hit by some shocks. meaning that they will have to borrow some money again to invest if they want to keep producing. But that is going to be subject to a financial friction, and that's where the balance sheet effects is going to kick in. Of course, this is exactly the moment where you have rigid wages, the model, and so that's why there's going to be a trade-off for monetary policy between the balance sheet effects and the aggregate demand. Okay, so the first thing I want to do is to take this as given. So let's first not think about why countries or corporations issue debt in dollars. Let's just take that as given. They have this money, this debt on the balance sheet, they have to reimburse it. So the level of their currency is going to matter for the net worth. And so just putting you at the perspective of time two, what is the optimal monetary policy response? And then I'll go back one period at the end and ask what is the optimal amount you want to issue in dollar. And from that perspective, taking into account what's going to happen to monetary policy in the future, what is the optimal macroprudential policy you want to put in place here, if any. Okay. So first layer of the model, very standard, households consume tradable goods and non-tradable goods. They have separable preferences. They supply labor inelastically. They can save in peso or in dollar. And I'm going to come back to that. But the crucial assumption here is that production is made by some perfectly competitive firms that have a linear technology to produce its non-tradable goods at time two, and wages are fully rigid here. Okay, and so because of fully rigid wages, if the interest rate by the central bank is set too high, then you get involuntary unemployment simply because the level of production is completely driven by aggregate demand here, since you have this rigidity. Okay, tradable endowments and the long run price holds. There is only one type of tradable good, and so the price of the tradable is simply the exchange. So that was the first layer of the model. This is households. The second layer is these entrepreneurs. I'm going to make them, extremely stylized to just get the balance sheet effect that I want to mention that we have in mind when you think about this dollar debt in this emerging market economy. Okay, so we are at time two. As I was saying, they enter the model with some capital stock that produces some non-tradable units. They have some peso debt and some dollar debt. We're going to focus on the effect of dollar debt here. That's the one that matters, and it matters because the net worth is simply going to be a negative function of the dollar debt, right? And a function also of the exchange rate. Meaning that if there is a depreciation, that E2 going up, then this net worth goes down. Okay, so far there's nothing special here. Now I'm going to add financial frictions, of course, and the way I'm going to do this is I'm going to assume that these entrepreneurs, they can at time two are hit by some random shocks. Some of them stay productive, some of them are completely unproductive. If you want to keep producing, you have to maintain your stock of capital if you're on the productive side of it. And for this, you need to pay some amount of money per unit you want to maintain. And you can borrow from other entrepreneurs to do this. And of course, here come the financial frictions. There is a classic monitoring problem at Tyrone, and the amount you can borrow from other entrepreneurs is limited upward by some parameters that determines the pledgeability of your future income if you maintain a stock of capital case. The only thing this is doing, in a very stylized manner, is that if these entrepreneurs are constrained, then the amount they can actually keep as productive capital is directly a function of their net worth that they have today. And of course, this is multiplied by the classic net worth multiplier that you have in this effect. So that's the balance sheet effect that I was mentioning at first. If you manage to increase the net worth of the entrepreneurs, this is going to be multiplied. So you're going to get a higher maintained stock of capital at period two. And so you're going to be able to produce more non-tradable goods in the future. Okay. Of course, one way to do this is to change the exchange rate. And so that's how you're going to get the trade-off between these two things in the market. Okay. Last friction that's needed in the small economy, and I'll of course come back to it and why you need it and sometimes why you don't need it. But let's first assume that households in this model can save in dollars, but to do so, they have to go through domestic banks, which is what we see in the data. So these banks are perfectly competitive, and I'm going to assume that it's costly to run such a business, so to intermediate dollar savings, and these costs are going to be proportional to the level of the domestic interest rate. So the idea here is that if you want to run a domestic banks that intermediates this dollar savings, then there is an opportunity cost of holding reserves, and that's proportional to the rate set by the central bank. So let's take this friction here, psi. I'm going to keep it in red. When psi is equal to 0, this side of the wall is completely frictionless. Okay. When psi is positive, then basically banks have to incur some cost to run the business that's proportional to I2. And so the effective interest rate they offer on this dollar savings is a negative function of the domestic interest rate. Basically, when your interest rate is very high, it's very costly to run such a business, and so you have to take a higher markup on this dollar saving. Okay, but for now, let's take it as given, and then you'll see in a moment why you need it or not. Okay, that gives a frictional UIP condition in the spirit of, again, Schmidt and Mukhin, where this psi governs the difference between the frictional and the frictionless UIP condition. Okay, so why do we have a trade-off here? The first side of it is the aggregate demand effect. That's very standard. When you increase the interest rate, you reallocate demand from non-tradables to tradables. And so because aggregate demand drives the production of non-tradables, you get a fall in consumption. Okay. And so here, increasing the interest rate is giving you a negative output gap. And you have this balance sheet effect that works with the UIP condition. So if you increase the interest rate, you appreciate your currency, that increases the net worth of this agency, they have dollar debt on the balance sheet, that increases the level of capital they are able to maintain in this period too, and then increases your output in non-tradables in the future here. Okay. So what do you do if you're a central bank here? You just trade off these two things. There is a threshold. I'm going to call B tilde. We're going to assume that we are above that threshold for the rest of the paper. That tells you that if your corporations have level of dollar debt that's higher than this threshold, then you have to allow under unemployment in this setup, which is just to say that the balance sheet effects are so strong that you have to allow for some slack in the aggregate demand side of the law. And so this expression is just telling you how exactly you trade off these two things. Very intuitively, the higher the level of dollar debt, that is B1 star here, the higher you have to set up your domestic interest rate. That's because you really need to appreciate your currency, right? Otherwise, the net worth is going to be very low for these agents. And you also have this I2 star here, that's the world interest rate. So think of it as set up by the Fed for now. When this goes up, you also have to follow suit. Why? Because there is a UIP condition. And so if the Fed has a very high interest rate, your currency is going to be relatively depreciated. That's bad for your balance sheet effects. And so you have to basically do this. Okay. Now, of course, that's one country with one level of dollar debt. If you think of Mexico, Brazil, Colombia, and so on, having all these kind of same things on the balance sheet of the corporation, this is the B1 star, then everyone has to do the same thing, which is increasing its interest rate when the Fed raises its interest rate, and that gives you a synchronization in domestic policy rate that I was mentioning at the beginning, which is the global financial. Okay. Yes. Let me skip that. This is just in graphically what I was just saying before. Okay, so this is what happened if you have one small open economy in isolation. As I was saying, we want to think about what happens if you have several of them. So let's think of a continuum of identical symmetric small open economies. So let's think of Latin America, for example. They all have the same level of dollar debt. And because they're all very atomistic, they're just going to take decisions in isolation according to the rule I was just mentioning before. Okay, now let's add something that's now very standard in state literature, and that's the Gabex and Majoré type of friction. This is just saying that if you want to send capital flow to the US, it has to be intermediated by some global arbitrageurs, and of course for them it's also costly to arbitrage these capital flows. They have access to the interest rate set by the Fed. This is $1, and they offer this rate to these countries. This is I2 star. Okay, and we're going to assume that it's costly to intermediate in a quadratic way, in the sense that the costs are just equal to 1/2 gamma. This gamma here is going to control the size of the friction. This is the very much the gamma in Gabex and Majoré. And they have to intermediate aggregate size of capital flow. So the reason I'm using this is theoretically taken from Bianchi and Lorenzoni, but you can do it with other ways. This is just telling you that in equilibrium, the world interest rate, so the interest rate that every small open economy here can use to finance itself, is equal to the one set by the Fed, plus the wedge here that depends on the aggregate size of capital flows sent from these small open economies to the rest of the world, divided by gamma, which is the size of the friction. So when gamma goes to plus infinity here, as in the Gabex and Majoré stuff, for example, the cost of intermediation goes to 0. It's frictionless to intermediate, and so the world interest rate is basically equal to the $1. When gamma is not equal to 0, then this thing kicks in. And so, for example, if you send a lot of capital flows to the US, this is negative, and so the world interest rate here is lower than the one offered by the Fed. Okay, that's the last friction you need. So let's just recap what the structure of the model here from the global scale. The Fed sets this interest rate here completely exogenously for their own domestic reasons. arbitrageurs use this rate with this friction gamma to offer the rate I2 star to every small economy. And then the domestic banks, with this fraction phi, uses Y2 star to offer this Y hat star to the household. Okay, so there's a lot of layers, but everything aggregates nicely here. So the question becomes, when is it efficient and when is it inefficient? Yeah, perfect. Thank you very much. I'm going to speed up a little bit so I can talk about macroprudential quality. One thing to start with is to assume first that this psi here is equal to 0. And what you're going to get is that even though you still have this friction on the gamma stuff, this equilibrium is going to be constraint efficient. So what's the intuition here? If you have non-separable preferences, what happens in this model is that the level of consumption of tradables at period 2 is actually independent of the domestic policy rate. And so capital flows you're sending to the rest of the world also independent of the policy rate. That's the thing that goes into this gamma friction that I was mentioning. And so whether you increase your interest rate by a lot or by very little has absolutely no impact on the equilibrium capital flows you send to the rest of the world, and so has no impact on the determination of this world interest rate by these global arbitrageurs, and so you don't get spillover between countries. The global financial cycle is constraint efficient, even though you have this friction that was mentioned. Okay, of course, this is the intuition for why this is going to break down. If you have a link between the domestic interest rate and the consumption of tradables, if you do non-separable preferences, you're going to get it. This is just kind of messy to work with. And so I'm going to do it with a financial wedge, which is upside different than 0, which is why I'm going to use this here. The reason is that it's most attractable. If you don't like this idea, even though I personally think there is some truth to this intermediation in emerging market economies, then you can think of it as just standard non-separable preferences. Okay. So why is it that it's inefficient now? Well, you just think of the equilibrium condition. The Fed increases the interest rate, that depreciates your currency. You have balance sheet effect because of financial frictions. So domestic EMEs increase their policy rate. The way they do this is because they want to appreciate the currency by attracting capital flows. Because of the intermediation layer, this increases the world interest rate. A higher world interest rate means your currency depreciates even more. And that's back into the first line. Okay. So you basically have conjecture externality because every country is trying to appreciate its currency or to attract capital flows at the expense of the other. And that's the conjecture externality. Here, what you can see is that you need a phi that's different than 0. That's the slide I went before. And you also need a gamma that's non-infinity. So you need these two frictions in this model to get the spillover, exactly like in the work of Dmitry and Mukhin, where you need these frictional global markets to get spillovers between countries. So this is the same idea here. You have spillovers, you have a need for coordination, of course. The nice thing here is that what the social planner that basically just the one that doesn't exist, but the one that would set the interest rate for all emerging market economies at the same time, taking into account these domestic decisions, the difference between what this social planner would do and what these individual central banks are doing is exactly quantified by the size of this congestion externality. If you're able to implement the coordination equilibrium, you end up with higher employment, higher outputs, and less depreciations in all emerging market economies, which is that you still have a global financial cycle, but this is very dampened because every country basically tries to attract less capital flows at the expense of one another. Okay, but the big thing here, I don't have a lot of time, so I'm just going to talk about the intuition for why you need this. What's happening here is that it's because you have dollar debt on the balance sheet of your corporations that you need to do this. And of course, each corporation, when it decides in the first period to issue some dollars, does not necessarily take into account that by issuing in dollar, it's going to tie the hand of the central bank in the future because the central bank will have to fight this balance sheet effect. So there is a more has a problem here that basically is begging for some bigger impact in order to solve that externality. Okay, so you want to do that as an individual country to avoid this issuance in dollar. Now, the nice thing about it is that this is privately optimal to do so, to tax your own corporations to prevent them from issuing too much in dollar, because you're going to have a easier trade-off between aggregate demand and balance sheet effects in the future. But the nice thing is that this privately optimal decision also has positive spillovers on the rest of the country. Thank you. I'm just going to conclude by saying this. If I prevent my own corporations from issuing in dollar, I'm going to hike less in response to a Fed tightening in the future. So I'm going to try to attract less capital flows. And so I'm going to have less of an effect on the world interest rate in the future. And so every other country is going to be happy because they will be able to attract, to fight the depreciations more easily. And so you end up with a global financial cycle that's also dampened, even though these decisions or privately optimal. And so let me not, belabor the point and just giving the floor to the discussant. Thank you.
Thanks so much. And the discussant is Tim Schmidt.
That's the microphone.
Welcome to this.
Oh, no, you go to the second one. Yes.
All right. Well, first of all, thanks a lot to Jesse for putting me on the program. This is an amazing session, super related to what I'm interested in. So, okay, I'm at the board, so usual disclaimer, these are my own views. I think you did a really good presentation, so I want to focus my summary on the things that I think are complementary to what you said. So the baseline is pretty clear. There's one instrument, there's two objectives. So you want to fight the balance sheet constraint and you want to achieve as much employment as you can. So it's kind of the baseline model. I think one thing that's pretty important and that is pretty straightforward if you think about a small open economy that's worthwhile to emphasize is in this model, there's no ability to affect the country's cost of foreign borrowing or the trade price. So this is not the typical two-country model where I change policy and that's going to affect the actual exchange rate and that's going to beggar my neighbor or anything like that. This is not happening in this model. This is all about, as I'm going to show you, about intertemporal substitution and substitution between tradables and non-tradables. So you're only kind of adjusting your domestic things. But that's pretty important because also think about relative to other papers in the literature, I think, that sometimes look at two-country models, for example, where you have actual effects on the exchange rate. Now, okay, so this is simply URP condition, but all I want to say here is the URP condition, no matter which version you're looking at, is assumed to bind, and that basically generates this mechanical link between your interest rate and the exchange rate. We talked about this, so this is pretty straightforward. So you have this entrepreneur balance sheet constraint. There's the net assets that I already substituted in, and then in the end of the day, when you increase the exchange rate proportional to your first period dollar debt, you're going to lower the ability to invest in the productive capital. And so you have this effect that when you appreciate the exchange rate, which means you lower E2, you're going to have more ability to invest, right? That's kind of the first channel. The second one is the demand effect. And actually, here's something I want to say that's a little complementary. So there's a relative price effect, right? Because you basically have the non-tradable good price in E2, which is the tradable good price. But in my view, you also have something that I would call an intertemporal income effect, because you're basically also changing the price over time. So basically, throughout the model, the assumption is that you're exporting more than you're consuming. So this is your endowment. This is how much you're consuming. So you're a net exporter. So if I change E2 in local currency terms, I'm going to make consumers richer in the current period. And so that's going to induce them to do intertemporal substitution as well. So it's not just traded versus non-traded, but also future consumption versus current consumption. So I think there are these two channels in the model, and I'm not sure you're really talking as much about the second one. And then things get a little complicated. I don't want to spend too much time on it because we already talked a bit on this on the side, because it's entrepreneurs also produce a non-traded good and then they also use it as an input. So that part, I think you can clean up a little bit. We talked about that. I think intuitively, it's pretty clear that you can generate this labor effect. I think everybody understands that. But if you actually look at the equations, I had a hard time seeing through all the different channels that are going on there. But we can talk about that later. I don't think that's interesting for most people here. And then we have this extension where you have this friction. And as I'm going to ask about later, I think you want to motivate a little more exactly why, as a bank, if I make domestic consumers buy a foreign bond, why that is a function of the domestic interest rate. I think that's something that is worthwhile to think a little more, because it's pretty, I understand you have the separable preferences as an alternative, but if this is your main story, as I already said, it would be nice to provide a little bit more intuition for that. I think this was pretty clear. So this is just how congestion works, so let me just skip that. So my general comments are, it's a very nice paper. Obviously, we all work on this, so it's a hot topic. We all like it. I think the mechanism is very intuitive. I'm not going to talk a lot about the literature because I think that half of the literature is in the room. So if anybody wants to say things, they can. I think there are a lot of papers that are related out there, and so it's something to think about. But I want to focus mostly on the key assumptions and also a bit on the exposition. And let me just jump right into it. So the first one is periods 2 and 3. So I understand from the way you write it is you want to make this a very stark thing. You want to make period 2 one thing, period 3 the other thing. But what that does, though, it's a little hard to see where effects are coming from. So let me just walk you through this quickly. So the first thing I want to show one more time is kind of this, if you throw all these conditions and clearing together, you get various intuitive things. So your borrowing in the first period and your consumption in the second period have to be equal to your endowment and your future borrowing. And what you want to see here is that E2 disappears from this equation. And this is exactly what I was saying. Your small open economy, this is your cross-border, I would call it a cross-border budget condition. You cannot do anything about it. This is just what the world market price tells you to do. Yeah. And so what that means is you can do whatever you want, but in the end of the day, you have to fulfill this condition. So you can't affect terms of trade, you can't affect the cost of debt. This is just something you have to keep in mind. So what does the interest rate do? It changes the entrepreneur's borrowing constraint because that's in local currency, and it induces intertemporal substitution, as I already indicated, and it affects the shift from traded to non-traded goods. So you have basically 3 different effects that you have there. 2 of them affect the labor, and the other one affects kind of this entrepreneur borrowing constraint. Now, here's where I think I would like to have a little bit more discussion, because in some sense, it's stark, but it's maybe a little too stark, because basically my reading is in period 2, everything's very, everything can adjust. So you can have this underemployment, but then in period 3, you make everything so easy for the central bank that you kind of by assumption have full employment. So the trade-off is not really underemployment period 2 or period 3, because you really just have this problem in period 2. And another thing that I found slightly confusing, and I don't think you really need it, is this utility function, because the utility function in period 2 has a sigma as elasticity of substitution, but in period 3 you just take the sum of the 2, which means that perfect substitutes. And I wasn't quite sure why you need that change, but it's like it brings like another dimension into the model that confused me as somebody who tried to go through the equations. The other thing I think that would be worthwhile talking about is like what drives unemployment and like how you solve for that, because the wages are rigid in all periods, but then you say like there's full employment in period 3 because there's no saving decision to be made, which I infer as saying the central bank can do whatever it wants because there's no future, which is okay in your model. But of course, like if you want to apply this to the real world, you would think about like period 3 still has some continuation. And so, I know this is supposed to be stark, but maybe you can discuss a little more like, how would this model look like if I have like an infinitely period model where I roll over stuff? I know that's a bit far, but I think it would be good to think about it, because in some sense, at the end of the day, that model would be what we as policymakers care about. And so then how much can we learn about that from this kind of stark model in some sense? Then there are a few financial assumptions which I think are worthwhile to discuss a little more. I already mentioned that motivating a bit more why the dollar asset intermediation is a function of domestic interest rate would be helpful. Another one is here we've throughout assumed that small open economies are net lenders, which I think empirically is not, with China and so on, but if you take China and a few other countries out, most emerging markets are net borrowers. And it wasn't totally obvious to me from the equations. I didn't have enough time to figure out whether everything goes through if you switch the sign. And that's something I would discuss. Again, like you're not allowing entrepreneurs to borrow in period 2 abroad. I don't think you actually need that assumption, because in some sense, the borrowing constraint should bind in any case, but it's just like an additional kind of constraint to the model, which, would be worthwhile to discuss. So, I think it's a very nice paper because it's very easy to see the things and have closed form solutions, but like some more discussions on these dimensions would be helpful. And the last thing is like this world interest rate threw me a little bit off, but I guess that's something people do in this literature. But there's not really a global market clearing condition in the sense I as a trade person would think about, for example. So instead, there's like this intermediation friction, and then you have like a total flows, and then you just have like a functional form that stands in for a true equilibrium. And so I think that's okay, but I think it would be interesting to discuss how a GE model would behave here, like how if you actually have global capital flows, if you actually have like the US and the other countries determine the interest rate in some kind of equilibrium, that would be really interesting. Yeah, so these were really my main points I wanted to make. I have a lot of other points, which I'm not going to bore everybody with. So let me stop here. Yeah, I think those were the main points. I think one last thing I want to say is that in the model, it's pretty clear what is the cost of dollar debt, but of course, the benefit of dollar debt is very reduced form because you're just saying dollar debt is cheaper than other debt. And so in some sense, I guess that's okay for this paper, but it's of course, as a policy prescription, if you say like policymakers should put a tax on dollar debt, that may be hard to defend with this paper. I think this is like one reason to maybe push more towards that direction, but I was wondering if in future work you can expand a little bit on the benefits of dollar debt and then have a better trade-off. Okay, well, thanks so much for giving me the opportunity to discuss this, and I should say this last one. I recommend reading this. Make life for the reader a little easier to put some of these details I'm talking about into the main text, and then I look forward to the next version.
Thanks so much. So, go for it. And I try to keep responsive to discussions brief.
Yeah. So thanks very, very much for all the great points and for taking the time to read the paper and so on. I'm just going to pick maybe 2 points because otherwise it would fill the discussion. What could I say? Yes, what happens in tier 3? Basically, there is like 2 ways to close this kind of model. Either you stop at tier 3 and then it's very easy, or you make it infinite horizon, but you basically say starting from tier 3, everything is flexible, and so it's basically the same thing here. I think this is easier, and that's also why I put this slightly easier functional form for the utility function, because it makes the marginal utility constant in tier 3. That simplifies, but you could do more complicated thing. I don't think it would change much. Let me just say for the last point, but then we should talk more because there's many things that we should talk about. So dollar debt is cheaper in the model. I think that's also consistent with what recent paper found. There's one very recent on Peru, for example, that shows that the weight between these two things is like pretty sizable, the interest rate you get as a small corporation when you ask for $1 or in peso, even though you're a completely non-tradable firm. And I guess my take on the paper was that whatever the reason is for why dollar debt is attractive, there is at least one part of it which is not internalized by firms, and that's this whole tying the hands of the central bank and creating spillovers afterwards. And so that basically calls for like marginally at least taxing dollar debt, not completely forbidding it, because it has other benefits. And depending on the size of the benefits, then you would tax less or more. But I agree with you. This is an open question. But thanks very much. There's anything we could talk about, but I'll just stop here. But thank you. And so any
questions?
Open for questions.
Go for it.
Yeah, I mean, I have a lot of questions, but just one to ask. So I think you even mentioned something about reserves, but I'm curious if the central bank could intervene in the currency market, not using interest rates, but FX interventions, right? Yeah. So in that case, would that kind of restore the efficient allocation?
So I think yes. I think that because I don't have terms of externalities in this. You would go back to basically the first welfare theory. Each country has like unlimited access to reserves to fix the exchange rate and can set the domestic interest rate. Then you will go back to the first base, exactly like in your paper. So, yeah.
So that is a really nice paper. I could be missing something. It's the first time I've seen someone do the like many country with the Quebec's majority friction. And so one of the things I was kind of curious about is I couldn't quite follow was how issuance of many countries enters the intermediaries essentially risk aversion of. Are you basically treating it as it's a country or currency specific risk aversion, because you could imagine that there's another externality that the more one emerging market borrows, the more effectively risk averse the other was. And so I wasn't sure if that was something you could kind of think through.
That's a great question, because it makes me want to clarify something, which is this is the Quebec's majority friction in the sense of putting an intermediary that has a cost. But this is not the Quebec's majority friction in the sense of the cost of intermediation depends on the risk of the exchange rate and stuff, like, because this is a riskless model.
Yep.
Basically. So if you want to microfund what I did, this is more like the Fontanier and Sprague type of thing, where you have like different intermediaries. They all have a cost of doing intermediation, and so that's how you get this function.
Oh,
so there is no risk in the model, so you don't.
But
get
even without risk, you could imagine that the more you lend to a country, the higher the interest rate is. That's what I mean by the friction. You're just having downward sloping demand. but it wasn't clear to me, is it one country borrowing more raises the borrowing costs for other countries, or you had country specific?
No, so there is one intermediary, and like all small economies are symmetric for that intermediary. So it's like if one country increases its capital flows, it's like no, it changes the interest rate for everyone at the same time.
So you've made them perfect substitutes for the
Exactly.
intermediary.
Yes. But okay, now I understand the question.
Yeah.
Yes. It will be interesting if that this type of segmented markets where you have one intermediary for each country, and then what would happen there? I think you would still need another layer to get the spillovers, but that's.
Any other questions here?
Okay, I guess that works. All right, well, thank you very much to the organizers, for including our paper on the program. And the first thing I have to say is this is joint work with Edith, who's at the board, and therefore the usual disclaimer applies. So let me talk a little bit about the motivation for this paper. So one thing that we know is that exchange rates can generate economic costs through dislocations. We've seen this with differences in prices due to recent events like the pandemic, the war, supply chain, difference of inflation that we've seen around the world. And more generally, we know that cyclical risk is something that in particular is one of the things that you might say financial markets could do something about. There's a large literature on that. And so in principle, we know that this financial markets can do this. And to some extent, people talk about this as a wedge, a deviation from sort of a perfect insurance kind of world. So the questions we're about in this paper is asking the question, can we use asset prices to value the exchange rate implied wedge? And we're going to basically say the answer to that question is yes. And the second question is, if so, how? So much of the paper I'm going to be talking about the how, actually, though it will take a bit to get there. So really, we're borrowing from two strands of the literature. One tradition is just basically looking at welfare cost of business cycles. And this goes back to Lucas's important welfare cost of business cycle literature. But there's, of course, a history of that. And the other one more specifically to this literature is on international asset prices and using international asset prices to determine this valuation wedge. This was kind of specified in a paper by Backus, Baresi, and Tomer. And more recently, there's been a number of papers who've tried to use that data returns to try to measure this wedge. And I'll say more about those in just a second. But just to make sure we're all on the same page, I'm sure many of you know this basic relationship, but let me just talk about it, because this is really the Backus, Baresi, and Tomer observation, is that if we look at complete markets, let me define what we're talking about here. Complete markets I'm going to talk about here is going to always have a star on it. That's not a foreign country, that's complete markets. And this is the exchange rate. And this is M, and M tilde is M is going to be the domestic SDF, stochastic discount factor, while something with a tilde is going to be a foreign country. Okay, and so under complete markets, we know that the SDFs are the same once you put them into the same prices, and so that means that it's going to hold with the quality. Now, what sort of Backus, Baresi, and Tomer said was, well, we can, and I'll show you why in a second, but they said we can think about there being a wedge on this relationship, and they called this thing eta. This is one of the few times, I think, in literature that people have always called it one letter, eta, so I will continue to call it eta throughout. Okay, so this is this thing called eta. And how do people usually measure this? So this was the thing that Backus, Baresi, and Tomer kind of noted. They said, well, if I think about, and what I'm going to do is put D's here, because now I'm going to talk about data. So we don't have to take a stand on whether it's complete markets or not. If we look at the data, we can take this, the SDF of the domestic guy, look at any arbitrary, so A is going to be just any arbitrary return in the foreign country, convert it into the same currency. If this holds, if this is the Euler equation that holds, there could be a wedge on the other guy. And something I'll come back to in a bit is notice that this is the domestic guy who has a wedge sort of in this formulation. these, in the interest of time, I'm not going to talk about all these papers that have done various things, but just to say some people like Lustig and Verdelin have looked at tradable, the tradable risk-free rate. Someone who looked at stock returns, others at the SDF features itself. Okay, so that's fine if you want to kind of maybe say something about there is a wedge, sort of in a positive way. But one thing that that Burnside and Graveline have made very clear recently is that if you want to say something welfare about it, is it good or bad? How important is this wedge? You really need to have a model. And the reason intuitively why is very simple, because if we're in a world that's not complete markets, if we move to some alternative, that financial market's going to change and the exchange rate itself will also change. So we can't observe something in the data if it doesn't hold. So what I'm going to do in my brief time is kind of try to say, how can we sort of think about valuing this? And how far can we go without a model? So what I'm going to first of all talk about is sort of some general model-free relationships to say, how can we value the complete market wedge just in principle? And then what I will do is say, what if we look at the goods market friction, and not take a stand on financial markets for the moment. And then what I'll do is come back and say, okay, but we know from Burnside and Graveline that we do have to say there is a model. And so I will take an off-the-shelf model and try to say, how could we actually value this? And I will say in all of this, there's going to be no new model. This is all going to be taking off-the-shelf models sort of on purpose. And so when we combine these three, we can come up with an exchange rate wedge that is going to be implied by asset returns. Okay, so there's a big literature, and I'm not going to talk about it, but I just want to say that obviously this relates to a big literature on international asset pricing with complete markets, a literature on welfare costs of risk, and also exchange rates and consumption. And of course, many papers that I've left off here. So let me say kind of what we're going to try to target. So how are we going to kind of do this? I'll show you the structure in a minute. But basically, the first part, I'm just going to say, let me just try to inform this kind of exercise, if you will, by looking just at consumption and exchange rates. And this is going to say nothing about asset returns. But the thing I want to just emphasize here, this is looking at US, Canada, and the UK. This is just looking at moments of consumption and exchange rates. And is to say that we're going to then, by kind of construction, if you will, have all the basic things we know about these things. In other words, consumption is too low, consumption correlations are too low. Real exchange rates and nominal exchange rates have certain volatility. And also there's a low correlation between exchange rates and consumption. These are all kind of things we know about at Smith, for example. And then I won't have time to go into this, but I will just say that at the end of the paper, I'll come back and then talk about asset returns. And here, what we're going to do is say, we're going to sort of discipline the analysis so that we can hit equity mean, volatility, risk-free rate, and volatility. Also, we're going to basically calibrate it to the UIP volatility and also the final regression. Okay, but for the first part, it's just going to be what I said before. Okay, so briefly, kind of what's this model-free part of it? Really, it's not, there's nothing new here. This is sort of taking from what other people have done, but just to kind of emphasize it. Essentially, the point is going to be, if we look at wealth, we can always write wealth as current consumption plus future expected value of consumption. And this is just really, if that sounds kind of, too vague, think of the standard thing you do. You teach, we teach our PhD students, at least some of us that do teach. And, you sort of say you do some kind of intertemporal optimization. You have, this could be a block, for example, of your, consumption and your model or whatever. You're going to intertemporally smooth consumption. And there is some wealth constraint that holds. Okay, just some, I'm not going to even specify what it is. And what we know is the value to that person of all future wealth is just going to be future consumption, whatever expected future consumption is evaluated at, remember, M is the stochastic discount factor in all future periods. Okay, so there's just, if you think about it, it comes out of your models all the time. So this is the thing we're going to call, actually, we're going to call it gamma, but the thing that's going to matter, and you'll see why in a minute, is this ratio is basically a price to consumption ratio. And basically, I'll say why here. Okay. So it's because in a lot of models, and really what I'm talking about here are going to be homogeneous utility models, which is a class that a lot of us work in. It's going to mean that if a utility is homogeneous, it's also going to be homogeneous. The value function is homogeneous in wealth and consumption. If you think about it, you say, oh yeah, I can pull out consumption. So it turns out that with recursive preferences, it has this form. It has the form that I can basically take 1 plus z to a factor. If you don't want to do it this way, you can do it other ways. There are other ways to sort of do it. But the thing I want to emphasize is, you can, if you're used to thinking of CRA, it's going to nest that. That's just one thing we know about recursive preferences. So that's your bet. But the thing I want to emphasize here is that this gives us then a convenient form to think about the value of this difference from complete markets. And that is this delta, if you will, which will be essentially if I take away consumption from the guy who's in complete markets, this is going to be the amount I take away from him. So in percentage terms, this is what would make him indifferent to being in the data world. Okay? And in principle, again, everything I've said here, delta could be 0. There's nothing to say it can't be. But then the key thing is going to be, how do I value the z in the data versus the z in complete markets? Okay, because everything here is just very general. Okay, so here's where we have to start making a stand on things. So the first part is I'm just going to look at the exchange rate, just look at the goods world for the moment. And I'm going to take some off-the-shelf versions of exchange rates. And in fact, I'm going to only because I only have 20 minutes and probably 10 or so now, is I'm going to actually just focus on one of them. But essentially what I'm going to talk about is going to be true for any kind of consumption aggregator in which everything is determined intratemporally. Okay. So we know, one popular one is home bias. That's kind of a frictionless world, right? Non-tradables, we already talked about it earlier today, is going to be one in which tradables can be traded, but of course non-tradables are sort of given. Other things that we worked on that we hope to have in the next version of the paper, CES aggregator. We could also add transaction costs, a la Obstfeld-Rogoff's sort of approach. Okay, but the key thing is we need to know, if we want to know the data, we have to say, what is that data? What are the allocations we see? Now, one in principle could go and get data on that, but what I'm going to do is say something internally consistent with this model is we could say, let's look at aggregate consumption and exchange rates and back out what would be the implied allocations. Okay, so that's what I'm going to do here. And just to kind of show you how this works with this non-tradables example, is we know from intratemporal optimization that within a period, there's going to be tradables and non-tradables. You give me, it's an aggregator, so you give me consumption. Then if I have parameters for how much I care about the shares of tradables, and I know the relative price, I can back out what that must have been. Okay, that's sort of the approach here. And moreover, we know something about that because we know exchange rates in the data. So if we know exchange rates in the data, we can back out what these things must be in the data and say, voila, as we say in French, where I just moved from, we can then extract how much is actually could be shared. Okay, tradables can, but non-tradables are stuck. Okay. All right. Then we say, well, if that's the case, we know if we take that and now go to complete markets, we could say, how would I figure that out? Well, I would say now I have stars. Remember, this is the consumption under complete markets. It's going to say that there's some omega, which is endogenous, that will be shared under complete markets of tradables that's in the world. So this is the total amount in the world. This is the amount we can share. And notice we're stuck with our non-tradables. Okay, so we're back to the thing I started in the beginning. The exchange rate is the ratio of stochastic discount factors how is this, where did this come from? This is just writing down specifically the Epstein-Zen version of what the stochastic discount factor is. Okay. But importantly, what's hidden in this is we have allocations, that omega, right? So omega is over here. We just talked about that, and omega is here. So we can use that to back out what needs to be the implied amount of omega that we're sharing. But notice we have our friends the Z's that are the prices of the future. And so we can't say more than that because we haven't said what the financial market is. Okay, so here's where we do need to take this down on the financial market level. Okay, so what we do is we say, again, we want to, we need an identification approach. Okay. So what we're going to do, and this is a little bit different from the literature, you know, in fact, I think it's probably better to see if you look down here. Because what we're going to do is we're going to say, we are going to look at the value of an Euler equation from the local perspective. Okay. And we're going to say there might be a wedge on the foreign. So if I'm domestic and I'm investing in a foreign asset, there could be a wedge. Why might there be a wedge? Well, because there might be financial frictions. We already talked about that today. I'll be interested to hear what Dima has to say about it. But you can see here, we're going to allow there to be some deviation there, but here's where we're going to say, we're going to use to identify it. Now, so what we're going to do is we're going to match the local asset returns using the local Euler equations. So local guys price the local assets. And we're not going to restrict the asset returns across countries, as I said before, to necessarily gold. Okay. They might, we're not making them either way. Okay, just to tee it up, and I want to emphasize this is with IID consumption. So for the moment, we are not matching asset returns. We're just going to take the parameters from that first table I told you, and we're going to, I just want to show you sort of something you might get out of it. So this is saying for different tradable share. So this is how much you care about tradables, 0.7 and 0.8. That's the coefficient on the Cobb-Douglas. You can see that the costs are increasing, right? Why are the costs increasing? Well, for a given amount of consumption and exchange rates, it says that the more that you care about the tradable thing that you aren't able to, that you weren't able to diversify, essentially you could have diversified it. So your costs are going to be like 2% of permanent consumption if that's given. Okay, now you can say, well, that's just about overall complete markets, and that would be right. And I want to come back to this eta wedge. Because notice that the way it's written down, it's not just exchange rates, right? It's exchange rates, but it's also a deviation with the stochastic discount factors. So how can we say something about how important are exchange rates per se if we tweak those and set those to what they are in the data? And I don't have time to walk through the sort of the algebra on that, but essentially that's what we're doing. We're just saying, what if we just change the exchange rate and everything else is under complete markets? Okay, and then we can think about a delta or a cost that's only an exchange rate wedge. Okay, so here's kind of what it looks like. We call this the S wedge. So you can see this part here is the non-tradable case I just showed you, 1.76 for this parameter. You can see here it's 3.07, so it's a bigger kick from the exchange rate itself. We also have a home bias example. In this case, actually, it goes the other way. So the home bias seems to have more already insurance from the goods market. And then just sort of as a benchmark, this is what it would be if the exchange rate didn't change at all. If it was what it is in the data. So that's 0. And in this case, the cost is higher because exchange rate prices are not adjusted. Okay, so I said that we would talk about matching it to asset returns. So what we do is take, again, an off-the-shelf model. So we take long-run risks, not because we necessarily love long-run risks, but because it is the model, the most sort of off-the-shelf that we know we can use to match exchange rates and asset prices and so forth. That's been shown in the literature. Other things that we've worked on, by the way, are disaster risk habit. Those things also would work. But just so you sort of see how it would work, we're going to do this. When we do this, we are able to match the other thing I showed you with equity returns and volatility and so forth. Notice that these are more muted. Why are they more muted? Well, here we're assuming that the correlation of persistent consumption across countries is perfectly correlated. So that means there's a lot of risk that's already been diversified. Okay. If there's time in the discussion, we can talk about other kind of tweaks to this. But I assume I'm good. Oh, I have 1 minute. Okay, good. So, say I was rushing. Okay, so what we do in this paper then is we show how, okay, just sort of big picture, how to value complete markets exchange rate wedge. As I said, it's just really comes out from a ratio of the value functions. And also to extract the commodity allocations that are implied just by aggregate consumption and exchange rates. Again, if that's not what you want to do, you can find your own data for that, but this is one way that's internally consistent. And then also using asset pricing moments to discipline the risk preferences given a financial model. And as we say, exchange rate wedges here are going to be those that would be implied across countries, not necessarily assuming domestic people have the wedge, they may or may not. Something I didn't have time to talk about, but we think is cool, is that you can also take the complete markets wedge and decompose it into parts that are coming from exchange rates versus the SDFs themselves. So we can decompose that and see what is the relative importance of all of those. So if you're interested, I could talk to you about it in the future. But the bottom line is we want to say that we think this is a general framework that can be used in a lot of applications.
Thank you very much.
So thanks a lot. Thanks, Jason, for inviting. I have a feeling that I spent the whole year preparing for this discussion because Karen visited LSC, so we had several conversations. Then I saw you presented several times, and then finally read it. This version, so it's great chance, great opportunity to discuss it. Okay, so just to give some background, right? So it's the paper aims to answer this one of the most important questions in international economics about how good is the international risk sharing. And I kind of thought a little bit about this, and in some sense, there are three approaches, right, that people took in the past. So one is to focus on international portfolio. You don't look at consumption, you don't look at the exchange rate, you just look at the international portfolios, and then if there's home bias in equity and other assets, that's kind of suggestive that the risk sharing is far from perfect, right? And this is largely where the literature started originally. So then there is another approach, which is much more popular in the finance literature, to focus on asset prices and exchange rates, right? So the most famous paper is by Brown, Cochrane, and Santa Clara, of course, right? So if there is the right correlation or movement between asset prices into countries and the exchange rate, that again can be informative about the risk sharing. And then finally, the third approach is relies on kind of macro literature, right? So it's about correlations of consumption across countries, or the Backus-Smith correlation between real exchange rate and relative consumption, right? And so, I mean, in principle, all these approaches can be followed, right? They all have their own advantages. The problem is that each of them has their own downsides, right? So in particular, this one is very largely partial equilibrium by just looking at this, correlations. You can't really infer, and I'm going to show that in a second. And here's a very similar problem. And so what this paper does, it effectively combines these two approaches, combines asset pricing approach with this more standard macro approach, and I think makes a lot of progress. Okay, so just to explain the idea, let me make maybe 2 steps back. So let's start with the simplest possible macro model, right? So let's think of 2 countries with one tradable goods, and there are kind of 2 limited cases. So one is financial autarky, in which case consumption is just equal to endowment in each economy. And then, of course, right, so in this case, the correlation between consumption will be just equal to the correlation of output. And then there's another extreme case when the risk sharing is perfect, when asset markets are complete, in which case we know that the optimal solution is that we just take the total output in the world economy and split it somehow between 2 countries in a constant way, right? So this omega doesn't have a time subscript. So it's in every period, in every state of the world, each country gets some fixed amount of this global output, in which case the correlation will be perfect across two countries, right? And so in the data, and again, this is kind of early literature from 1990s. So what people found is that this correlation is clearly lower than the correlation in output, it's clearly less than 1, and sometimes it's even lower than the correlation in output, which kind of suggests that the risk sharing is very important. So what is the problem with this approach? Well, there are two problems, right? So one is that this relies heavily on one good assumption, which is perfectly mobile across countries. And you can think of the opposite extreme when output is mostly non-tradable, in which case it's just not possible to obtain this equilibrium, even if asset markets are frictionless. And another problem is that this is a terrible model of asset prices, right? It's a terrible model of exchange rates. I mean, the exchange rate is just equal to 1. And well, most likely this model will not be able to explain asset price. And so this paper, it makes progress on both dimensions. Okay, so now think of again, two economists, but now with two goods. Okay, so home good and foreign good, you can think of tradable, non-tradable good. The results are very similar, the intuition is similar. So alpha is just the home bias, right? The share of home good in the domestic consumption. And let's start with the CRA preferences. Okay, so then what is the optimal risk sharing? What is the risk sharing under complete markets? Well, so you have the SDX into economists should be proportional to the real exchange rate, right? And this term should be equal 1. Okay, so this is kind of the wedge. It's slightly different from what Karen showed, right? So Karen also used eta, but it's the same. It's in the same spirit, right? So this wedge it reflects deviations from the optimal risk sharing in this economy. Okay, and so this is how you get kind of the Buckley-Smith condition, right? So if the risk sharing is optimal, then there should be perfect correlation between relative consumption and the real exchange rate. So then, but I mean, again, right, there are two variables here. And so how this, even if you have this wedge, it's not clear whether it will affect mostly the dynamics of the real exchange rate or relative consumption, right? That's the key point. Because imagine that you change this wedge, but it is mostly absorbed by the real exchange rate, right? And allocations, consumption doesn't change. So in that case, there will be no cost in terms of risk sharing, right? You change wedge, but it's only exchange rate which changes. We don't care about the exchange rate per se, so it doesn't really matter. On the contrary, right, it might be the case that mostly this C shock, it goes into consumption. And in that case, we have large deviations from the optimal risk sharing. And so how we determine that? Well, that depends on the goods markets, right? So this is where we need to take kind of general equilibrium approach. It's not enough just to look at this correlation. So we need to use the market clearing condition, right? So this is global market clearing conditions in relative terms, which depends on the home bias, right, and formalizes this intuition. So for example, if you have complete home bias, if alpha goes to 1, right, this term disappears. So consumption is fixed, it is determined by output, and then this wedge will be absorbed by the real exchange rate. Okay, so this is just the picture. So let me skip this. So this is right. So this is already progress, right? And this is what I think implicitly the paper does. But they are not happy with that, right? Because they still think this is not a great model of asset price. Right, so CRA utility is not great, and so this is where they introduce the Einstein preferences and potentially long-term risk. Right, so they change preferences and they get a more complicated risk-sharing condition, which involves this wealth to consumption ratio ZT. Right, but so that's, I mean, the spirit is very similar, right? So market clearing doesn't change; it's only the risk sharing which changes. The problem is that now, even if you have consumption and real exchange rate data, that's not enough to back out this wedge, right? You want to do counterfactual for the optimal risk sharing, so you need to back out this psi shock, but you can't do that because you have two equations and you have 3 unknown variables: relative consumption, real exchange rate, and also this wealth to consumption ratio. So this is where they have the third block, right? Where they introduce financial block. So they introduce long-run risk, and then so that this ratio, they should be dependent, right, on this unobserved long-run risk. And so how do they estimate these parameters, right? They need to know the volatility of the shocks, they need to know the persistence of the shocks. Oops, sorry. And so this is where they introduce the asset pricing equations, right? So they use the standard GMM approach to estimate these parameters by looking at the returns of asset prices. Okay, so this is kind of the short algorithm. So you use these equations to back out these parameters. Once you know the parameters, you can back out the values of ZT. Once you know ZT, you kind of can solve, and you have data on consumption and real exchange rate, you can back out this psi shock. And once you have this psi shock, you can do counterfactual, shutting it down and re-estimating consumption and relative. Okay, so this is kind of my interpretation of what the paper does. So very quickly, so what are the comments? The first one is that, so going back here, right? So if I understand correctly, the paper effectively imposes this long-run risk process on consumption, right? But consumption itself is endogenous in the system. So when you do counterfactual, when you shut down this precise shock, the process for consumption will change. And so potentially these parameters, this persistence, it can change as well, right? So I think it would be nice, and I don't think it would be much harder to do. I think it would be nice to instead impose this process on just exogenous output, right? And then the process for consumption will be fully endogenous. I don't expect that the results will change much, but I think just to make things more consistent. So then my second comment, and this one is more philosophical in a sense, right? So I understand that there are several arguments why we might want to introduce Epstein-Zinn preferences instead of CRA preferences, right? Because they can match this asset pricing moments better. But on the other hand, the implicit assumption is that we care about the risk sharing between households in two countries, and those are the agents who also price all these assets. But there's an alternative approach in the literature, right? That asset markets are segmented. So this is what Gabin Majori assumed. This is what we also assume in our paper with Ulrich. So there are households. They only trade their local bonds, and all other assets, right? And all this intermediation is done by arbitrageurs, and they price exchange rate. They can potentially price a stock market, even though, right, there's even disconnect between exchange rates and stock market, which suggests that even these markets can be segmented. And so in this case, it's not clear which preferences we want to use to estimate the welfare cost from better risk sharing. So maybe we should use household preferences, and maybe their preferences are closer to CRA rather than to Epstein-Zinn, right? And that's an interesting, I think, debate and problem to discuss, right? That's what makes it very special. It's something very special about segmented markets relative to this representative agent asset pricing model. And then finally, so I have a few other comments. So one is that this is really minor thing, but the paper uses this term sticky prices, meaning that exchange rate is not moving. But I don't think that's it. I mean, many people might get confused by this terminology because usually sticky prices can, we have sticky prices, but exchange rate, both nominal and real, are still volatile, right? And so I think it would be better to avoid this confusion. Another interesting thing is that, I was really surprised by the estimates, right? They are really high. So the cost of imperfect risk sharing are equal about 2% of permanent consumption. That's really a lot, right? This is usually how these are the numbers that people usually get in trade literature for gains from trade. But for risk sharing, it's the second order moment, right? So it's usually much smaller, at least an order of magnitude smaller than the welfare cost of trade order. Okay. So I'm kind of curious what drives this result. So is it because very high risk aversion and Epstein-Zinn preferences or something else? I would guess that if you just use CRA preferences, the number would be much smaller, but that's my conjecture. And finally, so there's another kind of small but interesting thing here, right? So if I go back to this equilibrium system, right? So here it was all about changes in consumptions, changes in the real exchange rate. And I guess that implicitly in the paper, there's an assumption that when you compute counterfactual, you take initial consumption as given, right? You change the path, but you kind of start from the same initial consumption level. But in principle, if you change the structure of asset markets, the level of consumption might change as well. It is another equation, which I don't show here, is the country's budget constraint, which pins down the level of the exchange rate, right? And so that's, again, I mean, I understand that it's very hard to compute that because you need to take, again, a stand on the risk aversion and other stuff. But in principle, maybe, right, how exactly you split these gains from risk sharing, that depends on this constant term, right? So that's, I think, another thing, interesting thing to discuss. Okay, I think that's it.
Thank you so much.
Well, I want to thank Dima for, yes, it's still very much work in progress. I think that's why it's not distributed yet, because and especially the sticky price thing, we're intending to take it out. I basically agree with everything you said, but I just want to clarify two things quickly. The thing about segmented markets, part of the reason why we didn't go the usual route with the wedges of assuming that domestic and foreign, basically the usual assumption would be domestic households are pricing foreign returns. What we're doing is we're saying domestic households are pricing domestic returns. You might say that's not even a good idea, but it is also more consistent with, this is what we try to say in the paper, two things. One is the segmented story. So we sort of see that as more, we don't write down, of course, the segmented world. That might be another extension. But the fact that we're purposefully saying only domestic guys are for sure pricing their own is sort of like our version of thinking about the segmented world. So, but I take your point on that. We should probably make that clear. The other thing is what you said about the level of change. That's actually important, and it's just a long paper. And the reason we originally wrote the paper in the following way: say people can have different wealth levels initially. And if people have different wealth levels initially, what that means is that if think of it as a planner would come along and say, hey, you're wealthier, to get you to sort of be involved in this financial market, I've got to give you more stuff initially. So there is exactly like your intuition says, there's exactly a level change. And what is that? That's just making sure that the value of wealth is the same. And so we made everything completely symmetric in this paper, so we could ignore that. But you're right. That's exactly sort of a hidden thing there. And we just worried the paper was too long, so we took it out and just made it. But everything else, let's talk later. The consumption being endogenous, that's another thing. We, as you say, we also played around with the production. If they're sharing production instead of consumption. Anyway, let me see if there are any questions or comments.
I have a question about incorporating the being practice here. So in the literature, sometimes we just stack the future consumption flow as a proxy for this expectation of utility flow equivalent to current consumption. So why didn't we take this kind of method in this decomposition exercise?
I'm sorry, can you say again?
I mean, so in the literature, like for instance, Georgian in 2009, what they did is they accumulate the future consumption flow as a proxy for this consumption equivalent utility flow. So why we didn't take this kind of exercise in this?
You're talking about like the AC factor?
Yes.
Yeah, I mean, we can do that. The reason we did it here, and I probably was going so fast it wasn't clear, but we're trying to make sure that these are hypothetical returns that we're actually valuing. So we're using the asset returns to discipline consumption, to then go back and say, what is the value of consumption? Because consumption is the thing that is really the wealth from the point of view of agents, right? So the AC measure, we could do that. Yeah, there's in principle we could. It's just that it usually has a measure of wealth behind it that's not necessarily based on consumption. Right? But in principle, okay, am I done? Oh yes, okay.
So
Getting the hook.
no. Oh no, I was asking you a question. So related to the size of the welfare cost, what I'm trying to get a sense of is, using your approach, what would you see in the data that would have generated, a very large cost of incomplete markets?
Okay. Yeah, and
Oh no, that was it.
yeah, I didn't answer that part because I was going to talk to Dima about it later. But in the literature, if you have it's sort of like if you look at, for example, Upsfeld Dole paper on this, he had really huge numbers. It was like in the hundreds of percent or something like that. And part of that was because what he was doing was everything. First of all, there was no exchange rate adjustment, and also everything was there was no sort of anyway. There were a number of reasons. So 2% is crazy. Maybe, and if you're thinking welfare costs, maybe it looks very large, but in the literature, sometimes that's not so big. Now, to answer more specifically, I think your question of like in the end, for example, when we disciplined it with long run risk. Basically, because we were taking the correlation of what you see across countries as given, in that sense, it's something like 0.76%. So it's not like 2%. So IID in general is going to have a higher cost, basically because there's no sort of mean reversion, if you will. Right? There's when you have some kind of mean reversion in the future and you really care about the future, that's what's kind of getting baked into this. then in that case, it gets more muted. So I think we don't, you know, and this question comes up and but just to be clear, we don't kind of want this to be seen as this is the cost. We would rather it be seen as if you want to take your model and think about through the lens of your model, what are the welfare implications of that model, then that's what we're trying to provide. That's all. Because any model is going to have different implications, and we know that.
Thank you very much.
Thanks a lot to the organizer, Jesse, for putting us together on the program. I'll be talking about risk sharing, application of the global financial network. This is joint work with Zhang. We're building up that system, so the mutual understanding applies. All right. So the two key questions that we address in this paper is first, what is the role of global financial intermediaries in facilitating international risk sharing? And we have a very specific definition for international risk sharing, which I'll get to in a few slides. And second, we want to look at how has that role evolved since global financial crisis. And there has been various literatures over the past decades that studies, especially the first question, and they share a few common features. One, on the reduced form side, they typically look at focus on the supply, right? Look at the supply of bank lending to different countries, respond to specific shocks, such as FX, US monetary policy, about the trend of the global financial cycle, for example. And on the theory side, usually banks are modeled with one representative financial intermediary. And the thing that we want to emphasize in this paper is first that both the supply of loans by banks and demand for loans by banks and firms matter. Second, you want to think about take into account both quantity and price. And third, that the heterogeneity across financial intermediaries is important to study the macro questions like international risk sharing. So let me be a bit more specific about the framework that we have in mind. So this is a stylized one. So you have different countries, and each country there is a banking sector. And banks, they can lend to other banks through the interbank market. They can also lend to firms domestically and abroad. And these bank to firm lending makes up the credit market. And along each arrow in this graph, there is a supply decision, a demand decision, and a price associated with each loan. Okay. And if you pop up and think about a multi-country world, now with more countries involved, this makes up the global interbank network. The bank to firm lending makes up the global credit network. And together they make up this global financial network. That's what we call in the paper. And banks, they form complex cross-border relations both with banks and with firms. Okay. So what we do is our goal is to provide a systematic analysis of the goal of banks, this global financial network in facilitating risk sharing, which is propagating shocks if you think about the opposite side of that coin across countries and across sectors. And we do that in 3 steps. First, we provide a structural model that encompasses both the global interbank and credit network. So in the model, banks are going to make portfolio allocation decisions across countries and across sectors based on expected returns and characteristics. And second, we're going to estimate the model. So we're going to estimate demand and supply curves for 19 countries using data from 2009 to 2019 and using balance sheet data from BIS. And these are going to be the first estimates of the price elasticities of cross-border lending to our knowledge. And third, using the model, we're going to conduct counterfactual exercises. And we're going to quantify risk sharing, or what we call insurance in the paper. And specifically, how we define insurance is if a country is hit with a country-specific local funding shock, how much funding it receives from the global financial network, okay, relative to the size of the shock it experiences is how we think about insurance. And we also look into transmission in the paper, but given this short presentation, I won't have time to get into the details. And we are going to do this analysis both across countries and over time. So really quick on the 3 key results that we're going to point out. First is that there is heterogeneity. in banks' willingness and capacity to provide intermediation across countries. And these are captured by the elasticity measures we're going to estimate. Higher aggregate supply elasticity of borrowers implies greater willingness and capacity to lend to that borrower. The second main result is that these elasticities explain the variation in insurance that countries receive when the country is hit with a country-specific funding shock. And the borrower countries with lower supply elasticities, they receive less insurance against the shock. And third, over time, what we find is that supply has become less elastic. What that means is that insurance provision has declined globally. And in some cases, shocks are getting increasingly amplified, especially in the global interbank. Okay, so starting with the model. Right. So this is going to be a model of global financial network. There are N countries, very much following the description of this stylized diagram that I just talked about earlier. The two sectors, there's bank and corporates. And each sector is comprised of N+1 borrowers, with +1 being the outside borrower. And the methodology we use, the setup is very much like the demand-based asset pricing model by Yale. And we're going to add a few elements, but the beginning, the optimal equation that we begin with is, so you have country N, their supply of loans to country M, sector L, funnels of nested loaded structure that is made up of within sector components and a cross-sector component. So this nested loaded structure can be derived from a Merton style portfolio allocation problem. So specifically for the winning sector component, it is made up of this delta that captures the desirability of countries to put portfolio weight into the destination country. And the denominator is kind of the lending opportunities out there. Delta more explicitly is made up of, is an exponential function of price, characteristics, you can think of as distance between countries or various GDP on various monetary policy regimes of the borrower countries. And there's a latent supply term that captures any unobserved characteristics. And for bank to firm lending, there has been literature documents, a lot of the cross-border lending are done in dollars. So we capture that with this spread term that's in additional to this local price lending term. And similarly, for the cross sector side, there is a very similar equation that is made up of the numerator capturing the desirability of lending to that particular sector, the denominator being the lending opportunity across sectors out there. These are the two elements that we add to the model. First, we kind of embed a network structure. So the total asset price in country N in period T is made up of one, domestic liabilities, so think of that as deposits. And second, this international liabilities that you can get from the global interbank network. So this is going to move endogenously within the network. And second, we're going to add this demand side equation into the framework. So the log quantity of loans demanded by each sector, each country, each period is going to be a function of the price of lending, the characteristics of the borrower country, time fixed effect, and latent demand. And to close the model, we have two market clearing conditions. The first is the market clearing from the banking sector. The second is a corporate sector. So total value is loan demanded less equal to the total value supplied. And there's an exchange rate determination equation where exchange rate is a function of the interbank rate differentials between the US and the destination country, as well as time fixed effect and the receipt. Okay. So that's an overview of the model, and we're going to estimate it. The data we're going to use is that from BIS, which I'm sure many people in the room are familiar with. And the nice thing is that it exactly maps to the setup that we have in the framework. Okay. So for example, we can see the data, how much US is lending to the German banking sector, to the German non-financial sector each quarter. The characteristics that we're going to estimate for the equations are ones that try to capture risk-expected returns. So for the borrowers, we're going to use their GDP, GDP per capita, inflation, sovereign default probability, stock market price volatility, monetary policy, and the index of macroprudential regulation. We're also going to include some bilateral characteristics, including distance and trade exposures. And for prices, for the interbank market, we're going to use the interbank lending rate. For the corporate market, we're using local currency prime rate or kind of local lending rate. And for the cross-border lending rate, we're going to use the US dollar cross-border lending rate. And our ultimate sample is going to be 19 countries from 2009 to 2019. So to estimate this, the nested logic structure of the framework provides two fairly convenient linear estimation equations. And we're going to do the estimation using 30-quarter rolling subsamples to tease out a time series for the elasticities. Okay. So there is going to be equation that's supply within a sector, then there is going to be a supply across sector equation. So this is kind of the typical supply question that you can think of, but the dependent variable here is the log portfolio weight in a particular country weighted by the portfolio weight in the outside sector. It's a function of price, the characteristics, and a residual term. And with this type of equations, we have the endogeneity concern, right? So high portfolio share and high prices, they are maybe endogenous to the high latent supply term, and that's going to bias upward the beta. And to get around that, our identification strategy is that we're going to use a structural model to construct implied instrument for the price. So we are going to use variables that's plausibly exogenous to the contained register supply system. That includes population, average income, historical social unrest. And the thing I want to emphasize is that these instruments are a linear function of all countries' endogenous characteristics. So we're not only saying your own population, the population of Germany is higher than Italy, is higher than of Spain, or we take the fact that Italy is also higher than Spain, Spain is higher, the income is higher than that of Turkey. So all these relative income differences, population differences across countries are taken into account to construct these implied instruments. And the intuition that you can think of is countries that have higher population, higher average income, that experience more social unrest historically, they have higher demands for loans and thus are willing to pay higher interest rates for these loans. So that's the supply side. And on the demand side, we're going to instrument the borrowing price with the regulation of the own country, own borrower countries. Okay? So the exclusion restriction is that the regulation stringency of the borrower country is uncorrelated with latent demand condition on our controls. These are kind of exogenous supply shifters that only affect the price by shifting the supply available of loans. Okay, so with the model and estimation, we get our supply elasticities. This is using the full sample, and the coefficient that we care most about are that on price, it is negative, so banks supply more loans as price decline or interest rate increase. And if you look at the coefficient on some of the other controls like GDP and distance, they kind of go in the direction that we expect. Banks are more willing to lend to larger countries that are closer to them. And more on the economic magnitude or elasticity magnitude that is implied by these is a 1 percentage point increase in lending rate leads to about a 40% increase in the quantity of cross-border interbank loans supplied. And that for corporate loans, that it's about 46%. Okay, and these elasticity measures are similar to the short-term debt elasticity measures from the 40-year papers. Okay. So these supply elasticities, we can now, if you write out the equation, we can interpret it and try to understand what they are really capturing. So this equation kind of spells out the aggregate supply elasticities for each borrowing country in each sector. Okay. And we can see that it kind of captures a willingness to lend component and a capacity to lend component. Okay. So the following two graphs are going to give some concrete sense about what it is really capturing. So for the first example, it plots the amount, how willing are US banks lend to foreign firms. The x-axis, that's a portfolio weight. The y-axis, it's kind of this willingness to lend. And as you can see, the willingness to lend increases in portfolio weights, and US is most willing to lend to the UK, followed by Japan, followed by Canada. And if we combine the willingness and capacity together, so you have willingness on the x-axis, willingness and capacity on the y-axis, and in this example, it's to the UK firms specifically. You can see that US and Australia have about similar willingness to lend to UK firms, but US has much greater capacity to lend to UK firms. And you can do this exercise now for all the countries, and if we plot them out, you can see that there's tons of heterogeneity in the amount of aggregate supply elasticities across countries. Okay. Then next, we conduct several counterfactual exercises to understand what does these elasticity mean for global insurance. And the specific example that we're going to start out with is looking at a US local funding shock and how much insurance US gets, given that local funding shock. So US is going to experience a 1% decline in domestic funding. You can think of it as a regulation shock that makes US banks less willing to lend. And the results here are going to be based on the first subsample of the analysis, so from 2009 to 2016. The first graph here is showing the amount of inflows into the US interbank market. So with the shock, in total, we're going to observe this total shock effect of about 0.8%. And it's made up of two components, a shock component and a global rebalancing component. The shock component is kind of the exogenous shock component. So that's just 1% here. And the global rebalancing component, that is now, we are now allowing portfolio weights to respond endogenously to the shock and observe what does that mean to funding for the US. And we observed that there is some inflows into the US given the US funding shock, and in terms of actual numbers, interbank rebalancing dampened the shock effect by about 11%. And you can do the same exercise on the funding side. There is a direct shock effect, and there is a global rebalancing effect that is all German banks are also rebalancing, changing their portfolio weight to all countries in the network in response to US funding shock, and transferring some funds into US firms. And there's also a self-rebalancing effect that is capturing both kind of the retrenchment of funds by US banks from abroad back to home, but that is also capturing kind of this indirect interbank rebalancing. So foreign banks are lending more to the US, and US bank thus has more fund that they can allocate to their own firms. And overall, we observe magnitude of about 45%. And you can do this exercise for all countries. So if we assume each country independently experiences global funding shock, how much insurance it gets. There is tons of heterogeneity. The first one, this graph is on the global interbank side. This graph is on the credit side. This graph is combining kind of the global rebalancing plus the self-rebalancing. And overall, we just want to highlight that how much insurance a country gets in response to its own funding shock is really varies across countries. So why is that? Now we relate that back to the elasticity measures that we estimated. And you can see that countries with higher supply elasticity, they receive more insurance in response to massive funding shocks. The x-axis are the elasticities, the y-axis are the various insurance measures. Okay. So linking back to the equation I showed, their lenders are more willing and have greater capacity to lend to these borrower countries. And so they're doing so through rebalancing in response to kind of the rising interest rate given the shock. Okay. So lastly, I'm going to talk about kind of the changes over time. So we estimate our supply curves using 30 polar rolling regressions. And with that, we get a time series of elasticities. And we find that there is a dramatic decline kind of the global interbank supply elasticity. The magnitude is quite significant from like 21% to 2% in 2019. And we observe some decline on the firm side, but not as big. And what that means is that overall there is just less insurance through these various rebalancing channels that I talked about. Now looking back at the US example, the dark purple line was kind of what I showed before. Now with using kind of a last subsample of our analysis, what we find is that there is kind of some decline actually in rebalancing, negative rebalancing. What that means is that the shock may actually get slightly amplified in response to the shock. And we do that again for all countries. And we plot out their insurance that they receive in the initial period relative to the final period. So everything below the 45-degree line means that there is less insurance today relative to before. And that is pretty much what we find for everyone in the interbank market. In particular, for some countries, they're below the zero line, which means when they experience a shock, the shock actually gets amplified for them. Okay. Then you may ask why, and one factor that we looked into is whether all the regulation that I've implemented since global financial crisis played a role. So we look at the correlation between the changes in regulation with the changes in elasticities. The left-hand side is looking at the changes in LCR, which is more related to the interbank market, and the right-hand side is looking at the changes in capital regulations relative to the changes in elasticities. And we observe a negative relationship, so more stringent liquidity and capital requirements corresponds to less elastic loan supply. And obviously, if you want to push this argument more rigorously, we need to have some model to tease this out. Okay, so in conclusion, we provide the first estimate of this price elasticity cross-border supply, loan supply and demand using a spherical model, and we find significant heterogeneity in these supply elasticities. They capture the willingness and capacity of banks to provide lending abroad. And countries with lower supply elasticities are going to receive less insurance in response to local funding shocks. Over time, we observe a significant decline in these elasticities, which means there is less insurance in the global banking network.
Thanks very much. And it's Katharina Bergant.
Well, thank you so much, first of all, for asking me to discuss this paper. I'm very well aware that I'm the only thing that stands between you and all the dinner plans you made. So I'm gonna hopefully provide a quick and a bit lighter discussion on this paper. As Jesse said, my name is Katharina, and I work at the research department of the IMF. Therefore, standard disclaimer applies. Oh, I have my own photo. So usually I like to actually draw in my discussions the story of the paper, but Leslie did such a good job in the paper already that I don't need to do that. And the story of the paper is therefore very simple. So we have two sectors, so to say. We have banks and firms. They can lend to each other domestically as well as internationally, and their interaction is gonna decide on the supply, the demand, and the price of the lending. So what I think is the coolest about this paper, I'm not going to repeat everything because Leslie has already summarized and shown the findings very well. And I'm not going to go in order. I'm going to go in order of what I found the coolest. I'm going to start with the counterfactual exercises, where she shows what would happen if we did not have this global financial network. And she finds actually the global financial network can provide some insurance because it mitigates the shock effect for the country that is directly hit because flows are redirected to that country. But also she shows that there is an amplification mechanism for the spillovers of the local shock to other countries abroad. The authors also show very clearly that there's 3 channels through which this happens. There's a global interbank rebalancing, so countries rebalancing towards the country in shock through their interbank network, but also global credit rebalancing, so to the real sector, and also some self-rebalancing where the country that is hit by the shock is retracting some flows to the domestic sectors. Also, what I found, the effects are very large. They're a bit different of what we just presented from the February version, so maybe something changed in the meantime. But so a 1 percentage point increase in lending leads to a 22% increase in the interbank lending. So these are sizable. And then they find that there's a lot of heterogeneity in how this happens, and they also go in the time series. So what I want to do now, I already summarized the paper. Then I'm going to tell you that I really enjoyed reading this paper. This paper is at a very, very advanced stage. It has probably been to more conferences than I have been in my career. So it is very elaborate and has done a lot of robustness. I'm going to provide some thoughts on the conceptual frameworks on the results over time. And then I'm going to provide some more questions that maybe more policy-oriented folks could ask. But let me say that, again, this paper is at a very, very advanced stage, and maybe all of my thoughts might be food for thought for additional papers rather than the current one. So my first comment is going to be that because this paper is in some sense so much better than many other papers that have looked at very reduced form bilateral bank lending, even with the same paper, is because it has this general equilibrium aspect. However, we know that between the banks and the firms and internationally, there's now also a significant share that is taken by non-bank financial intermediaries, and they make up a big share. So why I am saying this, just relax. Why I am saying this is because of the dynamics and the connection to the international cross-border flow. So do NBFIs matter? You know, are they really small? But here we plotted in our the IMF's Global Financial Stability Report, we plot here the share of, if you focus on the blue line, are the claims of banks' cross-border linkages with non-bank financial intermediaries. And you can actually see that not just that there's a significant rise in NBFIs, we all know that, but there's an especially significant rise in NBFIs, in cross-border linkages. So at the end of this time frame in 2022, banks' cross-border linkages with non-bank financials are around 22% of total cross-border claims. So thinking about, maybe you want to mention how you think that they could play into your story. And that leads me to the next point, the effects over time. It's very interesting that this insurance mechanism declines a lot over time. You provided this paper at the very end. I find it super interesting, but I guess to get to a firm conclusion, we would need to do a bit more than the correlation. I think actually the paper is already complete without this. Maybe some referee told you to do this because it's already a super rich paper. I think one concern we might have is that the use of macroprudential policy might be correlated with other things, for example, the use of capital controls, which are maybe more directed. And the second is you chose very specific instruments. I'm keen to hear why. I guess first of all, we have a bit more some self-promotion, some more sophisticated measures, because here you're just adding and subtracting dummies to get to the stringency of the regulation. We have some more measures that are taking into account the continuity of these measures. But also there's a lot of other that I would have looked at first. So I'm keen to hear, thank you, why you chose those. But also what I wanted to say, and this is very much correlated to the last point I made, is that there's actually some work by your colleagues at the board, Bergant and co-authors, and they actually show that when banks are hit by crisis, and they identified very well by loan exposure hit to and shocks to the real economy and the banks hit, they reshuffle their portfolio towards the NBFIs in times of crisis. These are not subject to the regulation, of course, but also maybe potentially, because you're not looking at NBFIs, maybe you see a decrease in the insurance provided by the global network, because actually banks are giving this insurance to non-bank financial institutions. So lastly, I have a few minutes left. So these are some policy-oriented questions that I would ask to derive from this paper. Since it's CEBRA, I dare to do that. You have a 1% funding shock in your model, and I think there could be a lot of done to see where actually the shock comes from. So funding shocks can come from a lot of sources. I guess stress in the markets, monetary policy, stress from creditors. Actually, funny enough, you mentioned in your presentation the regulation. This is actually something I was thinking about, because if I were to rebalance to a country as a bank, actually maybe a shock in regulation, a tightening in regulation makes me maybe more likely to provide insurance, because the sector is more likely to be more stable down the road. Whereas if the funding shock can come from signs of stress or of signs of inefficiency, then maybe I'm less likely to provide this insurance. But again, probably for another paper, but this would be very interesting. So one is also that you mentioned it several times, this heterogeneity about the elasticities, and you say that this is already well explained by the share they have in the portfolio. But one question is that if I want to build as a country my global network, who do I want to be connected with, and who can provide me this insurance? And you have this nice table. You put it in the appendix, but I thought it was very nice that you have the borrower and the characteristics about the lender and the borrower country, and how these influence how much insurance they provide. So do I want to be connected to a more capitalized banking sector, or to one that is more leveraged? And the last question before you all go to dinner is, how do we map this to the macro? So first of all, totally understandable that the BIS data is perfect for your needs. So, but how does this compare to the world? I guess we have, Jesse in the last session just showed us how incomplete the CPIS is, and I totally agree to that. But maybe we can have some macro statistics that map this to what's going on overall, because your shocks are always in relation to, and the insurance provided is always in relation to the size of the shock. So I'm not sure, do we have a decrease in the numerator or the denominator, in a sense that, do we just see a decrease of flows? I don't think so, because you're starting here in 2009 actually. And it seems to go up and down since there. In this graph, I actually just used the BOP and I mapped portfolio debt and other assets, which are mainly bank loans, and portfolio debt, which I think you're picking up with the BIS. I don't think there's a clear trend in this, so it could truly be all about just elasticity within this. Or maybe actually our shocks have become smaller. So this would be an interesting question. But as you said, macroprudential regulation increased a lot during this time, so it could also be that that's endogenous to that. So yeah, let me just conclude by saying that this is already a very rich and great paper. I think it's at a very good stage to be submitted, and it will be a big contribution to the international spillover literature.
Thank you very much.
You're gonna come on.
Oh, it's not working anyways, okay. All right, so let me just be really brief, thank you, Katharina, for the excellent discussion. I think these are great points. Let me just make a couple quick responses. First, yeah, the elasticity measure we have a slight different from the version you saw because our sample period, we used to go from 2005 to 2019, but then many of us, many people asking about, is our result driven by the global financial crisis? So we took out that. Now our elasticity measures are based on 2009 to 2019. And second, about NBFIs, I totally agree. I think this framework provides a good baseline to start embedding additional sectors that may be important for financial intermediation. So you can easily think of like extending this model to a third sector that's non-banks, and think about the substitution decisions between non-banks and banks and firms. But we focus on banks. If we looked at for different countries outside the US and look at how much of their funding is funded by banks versus non-banks versus other sources, banks still make up kind of the largest share of funding for different countries. Like for emerging market goes almost up to like 90-some%, and for even Europe it's like 60-some. So that's why we are focusing on banks for this sector. And all the other great comments for the regulation, I guess we are using index from the IMF. I guess there is a better one now that's more granular, so we'll look into that. And all the policy questions I think are kind of a motivation that what we think our framework will be good at. We can implement different types of shocks and see how they respond. And why we measure our results relative to the size of shock is because we think that provides kind of a nice apple-to-apple comparison that we can do across countries. But of course we can focus on the numerator and look at the absolute value of the flows. Okay.
Question.
Yeah, questions. First question. Do you think about globalization? Since now there are many companies which are trying to win the game that you are explaining. There are tax havens. There are companies which select locations specifically to get cheap funding. I will register my company in Luxembourg. Maybe to get better funding. So over time, you got different estimation results for your recent quarters and the early quarters. I think it may be related to the fact that now there are these international companies which specifically pick the locations. So it will be a cheaper funding, better access to markets.
So that's a good question. I think one robustness test that we have done is kind of using Jesse and Mateo's kind of reallocation matrix to see whether we can reallocate kind of the residence-based versus country-based type of measures to see if that makes a huge difference. The thing, of course, is like bonds and banks are different. So we didn't put that in a paper, but we have done some exercise linking that. And the results weren't driven by that as much because I think when we look at these patterns over time, at least for the sample we're looking at, we didn't see no dramatic shifts as the one that we're documenting. But I think that's a fair question to consider.
The question was about production. In a sense, the results have possibility now for this global network to impact the production of specific countries, right? And my understanding is that you take GDP as exogenous, right? So you don't have this spillover effect.
So the outcome variable we're focusing here is kind of the bank funding to different countries. And we use the characteristics that we have in the model are kind of exogenous, and you're definitely correct on that point. So the fundings are not responding endogenously to changes in characteristics such as GDP. But that's no, as the literature moves along, I think we can make more and more of these characteristics endogenous, and see how the allocations respond to that.
So I really like Katarina's point about like which kind of countries are linking together, and what that brought me to thinking is like what kind of insurance you're having, like, because in some sense you have crisis times when you have a big crisis, and the question is, are you going to replace that funding, or do you look at small fluctuations in lending and there's like changes on the margin, which I think are very different types of insurance. And so one thing that jumped out at me when I looked at your chart was Turkey, which is like a 70% insurance. I was just wondering, is that like the period that Chapman covered, where like they just borrowed a lot abroad, but I'm asking myself, like, if Turkey fails tomorrow, are we all going to jump in and give them money and actually insure them? So I think in some sense, can you tease those two things apart by maybe looking at, thinking about big shocks versus small shocks, something like that, or crisis periods in these countries? Because it's a big question, like, are you insured against the worst case, or are you just like on the margin, like, across these countries?
Yeah, that's a good question. So two things. One, why Turkey looks like it has so much insurance is a 1% shock in Turkey is still pretty small in absolute value relative to other countries. So there's more capacity in the world that can insure Turkey against any country-specific shocks in there. But in the paper, we have looked at the bigger shocks. So we kind of use the same magnitude of the shock as a global financial crisis and look at like a GFC shock. And if it were, and what we see is that as more and more countries are getting hit by the shock, and the global financial network breaks down things. And I think the intuition is kind of goes along with more and more countries experiencing shock. There is less and less kind of willingness and capacity to provide insurance to these countries that hit with a shock.
Yeah, I guess my bigger question is, are the supply curves you estimate in normal times relevant for crisis times? So I think that's hard. I mean, it's a little hard to estimate, but I wonder if you estimate the supply, just I don't know.
Yeah, so
it's my point.
Right. That's a good point. Yeah, so I guess the earlier version of the paper that we had included the global financial crisis. So you can think that if we compare the results, including that sample period versus the later sample period, and look at the difference, maybe we can talk more from there.
Thank you